Inheritance tax came into limelight in the past few days as it was spoken by Sam Pitroda amid the wealth redistribution manifestation just before the verdict 2024. As a part of our today's discussion, we are going to see what kind of inheritance tax system that is prevailing in the United States. Yes, the United States does have an inheritance tax system known as the federal estate tax. It's a double taxation as far as the United States is concerned. In 12 states of United States of America, not only the federal tax has to be paid, but also the state level tax has to be paid. That is why it's a kind of double taxation. In the rest of the states, it's the federal tax alone that one needs to pay. Federal estate tax is a tax levied on the transfer of property from deceased individuals to their heirs or beneficiaries. The tax applies to the net value of the deceased person's estate exceeding a certain exemption threshold. For 2023, the federal estate tax exemption is $12.92 million per individual. That is to say, if an individual has an estate or inheritance to the tune of $12.92 million in Indian rupees equivalent to around 107.2 crores, they need not pay any inheritance tax or estate tax. If the deceased person's estate value exceeds, say, 107.2 crores, then the exceeded amount, whatever it is there, on that one needs to pay federal tax. The top federal tax rate is around 40% of the excessive amount over and above the threshold limit kept as an exemption. Now coming to state level estate inheritance tax, what we can understand is, in addition to the federal tax, some US states, that is to say around 12 states, also levy their own estate or inheritance taxes. As of 2023, there are 12 states plus the District of Columbia that impose state level estate or inheritance taxes. The state level exemption amounts and tax rates also vary across those states. Now, one may ask a question, that is, what kind of exemptions and deductions that one can get in USA as a part of inheritance tax or estate tax. There are certain exemptions and deductions that can help reduce the overall estate tax liability. For example, transfers between spouses are generally exempt from estate tax, and also charitable donations from the estate can also be deducted. Over and above, at the federal level, there is an exemption to the tune of $12.92 million. That is the limit allowed by the federal government to levy any kind of federal inheritance or estate tax on any individual. As it was stated by me earlier, there are currently 12 US states plus the District of Columbia that impose a state level estate tax or inheritance tax. That is to say, total tax liability of an individual in USA in 12 states and in District Columbia is going to be the federal tax that one needs to pay over and above the threshold limit kept, and also the state level inheritance tax that one needs to pay over and above the threshold limit that was decided by the local governments. Whereas in the rest of the USA, only one needs to pay the federal taxes on inheritance. The pros in the case of federal taxation on the part of inheritance are, it helps generate revenue for the government, it reduces wealth inequality by imposing a tax on large inheritances, and also provide an incentive for charitable giving and estate planning by the rich. And the negatives are that it can result in a significant tax burden on estates, especially for family-owned businesses. Complexity of the tax code and exemptions can make compliances very challenging. and also it is perceived as death tax that discourages capital formation and investments. Whereas at the state level, the pros of inheritance tax are it provides additional revenue for state governments and also it allows states to tailor their inheritance tax policies to local needs and preferences. It can also help offset the impact of the federal estate tax at the state level. And the negatives are one, it can make a state less attractive for retirees and wealthy individuals, leading to migration. Two, it adds an additional layer of complexity for estate planning and tax compliances. And three, potential for double taxation if both federal and state level taxes apply. Overall, the debates around federal and state inheritance taxes involve balancing considerations of revenue generation, wealth redistribution, estate planning, and economic competitiveness. Reasonable people can disagree on the appropriate role and design of these taxes. Over and above, the interplay between the federal and state level inheritance tax laws can be quite complex with different exemption amounts, tax rates, and rules. Now, the proponents of redistribution of wealth in India, who are all talking about a possibility of inheritance tax as one of the ways for redistribution of wealth, need to keep in mind that the estate tax was prevalent in India till 1985. In 1985, the estate tax on the transfer of property after death has been abolished by the then Congress government. We still have stamp duty when immovable property is transferred through inheritance. The recipient may need to pay a stamp duty, which is levied by state governments. The stamp duty rates vary across different states in India. Over and above, we also have capital gains tax in the case of inheritance when the inherited asset is later sold by the recipient, and if he has any capital gains, on those capital gains he has to pay capital gains tax too. Beyond these limited taxation aspects, India does not have broad-based nationwide inheritance tax system like that of the United States. The idea of reintroducing an inheritance tax after its abolition in 1985 has been widely debated in India from time to time. One needs to go for a wide debate before any action on the part of reintroduction of the abolished inheritance tax in India. Hope the information is useful. Thank you very much.